In the last few months, we have seen some definite changes to the real estate market. So, what's happening in the real estate market and how does it affect me? That is the burning question on everyone's mind. And in today's video, we're going to dig a little bit deeper and discuss what's going on nationally here in Canada, but also more locally in the Toronto GTA and surrounding communities within Peel region, being Mississauga, Brampton and Caledon. If you like this information, hit the thumbs up and subscribe so that we can get more great content out to more people. We put out a new video every week, so hit that bell. My name is Evelyn Lopes with the Evelyn Lopes Realty Team and iPro Realty. We've been helping families for over 30 years, providing information with interpretation so that you can make best and informed decisions for yourself and your family, supporting you in living the life of your dreams in the home of your dreams. So what's going on in the real estate market? We have seen a definite shift in the market in recent months. What's up? In this two-part series, we're going to go deep and uncover and, more importantly, understand some of the elements that are affecting the changes we are seeing in today's real estate market. And is it too late? Too late for buying? Too late for selling? Is it too late? Here's what you need to know. Let's start with a little context, some background information. The real estate market has been on a rapid incline, especially during COVID. The federal government was keeping interest rates artificially low in order to keep the economy stimulated. With most things in lockdown, people were working from home and they needed more space to do so. People were saving money because there wasn't too much to spend their money on. No trips, no travel, no entertainment. Many people were able to save money and they wanted and now needed new accommodations. Many were able to extend the radius of home to work distances due to new work options. They were also able to move out farther and farther to more distant locations. Interest rates were artificially and unprecedentedly low. This was done by the government in order to keep the economy going during the pandemic, meaning borrowing costs were low. The high demand for housing, coupled with the very low levels of inventory, caused a buying frenzy in the marketplace. Buyers were willing to pay more because their carrying costs were low due to the unheard of low interest rates, which they very soon became accustomed to. This frenzy for housing pushed prices higher and higher, and buyers wanted to buy as quickly as possible because every month it seemed that the cost of a house was increasing dramatically, creating very strong levels of demand. Because of changes in the workplace, many buyers were able to venture farther and farther away in order to try and secure a home. They were willing to bid higher and higher for homes because they felt that if they didn't buy today, tomorrow it would cost them more. Low borrowing costs facilitated their ability to pay these higher purchase amounts. On the other side, sellers were not in a rush to sell because if they waited, their house would be worth more. That, coupled with the fact that sellers were not so inclined to have people entering their sacred home space during a lockdown and a pandemic. These inventory levels low, especially at the beginning of the pandemic, which ultimately ended up contributing to lower and lower inventory levels and increasingly built up demand. The result was a seller's market. So what is a seller's market? A seller's market is when there are more buyers or more demand than there are current homes for sale or the supply of. In a strong seller's market, sellers are in the driver's seat. Prices strengthen or increase, homes sell quickly, and in some cases, which ended up being the majority of cases, sellers get multiple offers and the properties sell for over list price. In addition, new bills have been extremely low for quite some time. The red tape of government bureaucracy has made it more and more difficult for builders to build. and new starts have been very low for, well over a decade. During the pandemic in particular, builders saw the cost of materials rise to unprecedented levels. For example, the cost of a 2x4 increased by more than 3 times its original value. Builders saw these costs that just kept rising and rising, and with all this uncertainty, builders were reluctant to commit to a project because it was hard to forecast the future costs during the building phase. And builders could hold on to their land, hold on to their projects, and see their value rise week over week, month over month, so they were under no real duress to build. In addition to high material costs, there were and still are shortages in the availability of labor to actually build those homes. Demographic changes in the population fueled the fire. The younger population in large numbers was reaching the age of buying a home, and older populations, which were also increasing in numbers, were looking to downsize, and they were searching for, in many cases, single-level homes. And the continued migration from other areas of the country to metropolitan locations such as the Toronto GTA, as well as new immigration that was also to be entering into the mix, and those people also needing housing, has put an even greater strain on access to housing and affordable housing. All this has heightened the impact of low inventory levels. The challenge is that this particular issue can't be fixed overnight. There is fundamentally a shortage of homes. There we have it. The perfect storm for supply and demand issues, resulting in low inventory levels, high demand, and ultimately higher and higher prices. So what's next? What has changed in the last few months? We saw a very strong market in late 21 and early 22, January, February, and the beginning of March. Then it was almost like overnight things began to rapidly change. What happened? Well, a few things came into play. Buyer fatigue. Buyers were getting tired of the bidding wars, of submitting offer after offer only to be outbid. We were told of interest rate increases that would be coming. The government wanted to get back to more real interest rate levels as the economy opened up. And globally, interest rates were rising in part due to inflation. And rising interest rates would hopefully curb that buying frenzy. But what we tend to forget is that the Bank of Canada interest rates before COVID, like in January 20, were 1.75. During COVID, they dropped to 0.25, and today they sit at about 1.5. That's still below pre-pandemic levels. According to the Canadian Real Estate Association, in 2021, both the number of sales and the average home prices hit an all-time high, with demand for new homes far exceeding the supply. This trend continued throughout early 2022, despite widespread predictions that the Bank of Canada was gearing up to increase interest rates. This chart shows the Bank of Canada overnight rate history from 1940 until our present day. But let's concentrate on what happened more recently, and that is pre-pandemic, pandemic, and post-pandemic. Looking at the chart here, we can see that the rates were pretty stable right up until about February 2020. At that time, the Bank of Canada rate was at 1.75% and had been at that rate for, you can see, quite some time, since about September 2018. What happened in February of 2020? Well, we all know that was COVID. And COVID really came into play early March, late February, in that time frame. And so in response to that, the Bank of Canada rate dropped. It plummeted from 1.75% to 0.25%. And it maintained that really unprecedented low level for quite some time. Then in February of this year, we were still sitting at 0.25%. But what happened next? We experienced our first rate increase, and we were told that it was coming in March. And in March, that rate increase came in at 0.25%. So then the rate was sitting in April at 0.5 point. Then in April, we received our second rate increase of 0.50 basis points. Now the Bank of Canada rate was sitting at 1%. And again in June, We had our third consecutive rate increase. This time it was another 0.5 point. And so here we are in June with the Bank of Canada overnight rate sitting at 1.5%. But if you look at the historical numbers, you can see that we are still well below what is average. The challenge we have is that the people in general are just concentrating on the fact that the rates are going up, but they fail to recognize that we are still at this point below pre-pandemic levels. So pre-pandemic was 1.75 and currently we're sitting at 1.5. And we have also been told that those rates will continue to increase, and in part to try and get back to more normal rates, and also to try and curb the inflation that we are experiencing. Currently, our inflation is running at about 6.8%, and keeping in mind that the target rate was 2%. So we are considerably over in terms of inflation. So by increasing the Bank of Canada overnight rate, that will make it more expensive to borrow money and hopefully curb some of that excessive spending. The challenge is getting that rate just so that it doesn't tip into a recession. But now that the central bank has officially begun pushing its key interest rates back up from emergency levels, the housing market is responding, with the pace of home sales cooling since March. The Canada Mortgage and Housing Corporation predicts that the housing market will continue to moderate in the coming year. Feds plan to keep raising interest rates as necessary to fight inflation, which means target rates could rise by another 1 to 2 points or more over the next year. That in turn will cause both fixed and variable mortgage rates to rise. As Senior Deputy Governor Carolyn Rogers noted in May when she said, "We need higher interest rates to moderate demand, including demand in the housing market. House price growth is unsustainably strong in Canada." So that's the government's take on it. But what does this mean for you? If you're shopping for a new home, expect mortgage rates to keep rising well into 2024. So you'll need to act fast if you want to get in at the lower rate. However, this cooling effect should make for a less competitive market, and we can help you chart the best path. If you've been thinking about selling, higher mortgage rates may shrink your pool of potential buyers because they just can't afford it. So you don't want to wait too long to list. And if you are up for renewal, you should also act quickly or risk paying a higher interest rate. Although interest rates are part of the story, they are not the whole story. So what else has impacted the market? Inflation, rising costs of essentially everything, which has again caused the government to step in and increase interest rates in an effort to ward off inflation. But it's a tricky balance. What else? Global uncertainty. With new strains of COVID earlier this year, supply chain issues of moving goods and services, and global unrest and war, all these factors have played a role in the changes in the marketplace. And these changes have had a psychological impact on buyers and sellers. Buyers have stepped away from the frenzy, and as a result, there has been a decrease in demand and prices as the market has cooled down, which really those prices were unsustainable for the long run. As prices begin to stabilize from a seller's market to a more balanced market, we're seeing this overall cooling down. As the Toronto Regional Real Estate Board President Kevin Krieger recently said, Bank of Canada rate hikes, including the 50 basis point hike on June 1st, which was about a week ago, are impacting home buyers in the short term. There is now a psychological aspect where potential buyers are waiting for the bottom in price. This will likely continue throughout the summer. However, as home prices adjust to higher borrowing costs, housing demand will be supported by extremely low unemployment, high job vacancies, rising incomes, and record immigration. And what's the result of all these factors? Well, unfortunately, buyers, this will make it a little bit more expensive for you to purchase your next home. And with rising interest rates, you're going to qualify for for a little bit less, which means sellers, again, you can expect that more limited pool of buyers making offers. But it's not all bad news. Here in the Peel-Dufferin regions, northwest of Toronto, we're seeing a shift in the marketplace, and the markets are leveling off towards that balanced market, which is good news. And this means that the real estate frenzy is calming. Inventory levels are increasing, giving buyers more choice and less stress and more negotiating power, which is what they wanted these past 2 years. And although interest rates are on the rise, they are still historically very low. And for sellers, the markets are still active. And although prices are down slightly from earlier this year, prices are up year over year, making it still a good time to sell. There is a great opportunity to drive demand and higher sale prices for your home. However, you will now need to be more strategic in the way in which you go about selling. You need to ensure that your home is priced properly. It has to be perceived by buyers as the best on the block if you want to actually sell. You have to ensure that the home is presented well, and you can request a copy of our free report, 32 Tips to Increase the Sale Price of Your Home. Simply click on the link below. The days of putting your home at essentially any price and having the market catch up to that price of selling are gone. And the strategy of underpricing to try to instigate a bidding war is also waning. What prudent sellers need to do is to prepare, price, and promote their homes to their fullest extent, which can be achieved by working with a knowledgeable realtor. You can request a free copy of our Home Seller's Guide, and again, you'll find the link below. We're here now. What's next? Check out part 2 in this series, where we'll investigate the regional Toronto area and local market trends, specifically here in Peel region, being Mississauga, Brampton, and Caledon. We'll dive in with the actual numbers and look at the trends so that you have more information to help you and your family make the best and informed decisions for you. Each and every person's situation is different, and what's good for one person is not necessarily good for another person. So when making these big life-changing decisions, it's important to, first of all, understand the circumstances, to understand what's happening and why, to sort of forecast what's going to come in the future, keeping in mind that none of us have that crystal ball. We don't know for sure what's going to happen one way or another, but we can sort of trend out what we think is going to happen. And based on all of that information, and based on our specific situation and our tolerance to risk, we can make best and informed decisions for ourselves that we feel comfortable with. So stay tuned for part 2 in this series to understand a little bit more of the numbers behind this change. I'm Evelyn Lopes with the Evelyn Lopes Realty Team. Thank you for the privilege of your time. We'll see you in the next video.